Hi folks, welcome back to Murthy Finance Academy. Today, we're diving into some really important changes from India's market regulator, SEBI. These are big upgrades designed to make the whole world of mutual fund investing a lot simpler and way more transparent for all of us.
So if you've ever looked at the thousands of mutual funds out there and just felt completely lost, you are not alone. For a long time, especially for new investors, it's been a really confusing maze to get through. You see, a huge part of the problem was this. Fund houses would launch all these different schemes with exciting names like Growth Plus Fund or Dynamic Returns Fund. But when you actually looked under the hood, they were holding pretty much the same stocks. It was almost impossible for an investor to tell them apart.
This was especially true for a whole category of funds called solution-oriented funds. They were marketed for big life goals, like saving for retirement or a child's education. But as Dhirendra Kumar from Value Research rightly puts it, it was really just a marketing label. They were often just regular balanced funds dressed up to look special, without any unique strategy.
So to cut through all this noise and bring some real clarity, SEBI has made a pretty big move. They are discontinuing the entire solution-oriented category. That's it. Gone. Existing funds are going to get merged into other schemes, and no new money can go into them. But this isn't just about getting rid of the old confusing stuff. SEBI is replacing it with something much smarter, and frankly, a lot more powerful, especially if you're just starting out. Let's talk about this brand new category, the Life Cycle Fund.
Okay, so what is a life cycle fund? You might have heard it called a target date fund. In simple terms, it's a set it and forget it kind of investment. You pick a fund based on a future goal, say your retirement in the year 2055, and the fund automatically manages everything for you until that date.
And this is what makes it such a game changer. You don't have to worry about all that complicated stuff like asset allocation or portfolio rebalancing. The only thing you need to figure out is that one single question: when do you need the money? The fund handles all the tough decisions after that. So how does it actually work its magic? Well, it's all about something called a glide path. Just think of it as your investment portfolio being on autopilot. Its whole job is to gradually and automatically lower your risk the closer you get to your goal. Let's walk through an example. Imagine your goal is 30 years away. The fund will start off pretty aggressively, with maybe 75% of your money in equities or stocks. Why? Because you have tons of time to grow your money and ride out any bumps in the market. Okay, now let's fast forward 15 years. You're halfway there. The fund, all on its own, has started to shift gears. It's automatically gliding away from the higher-risk stocks and moving more money into safer things like bonds, creating a much more balanced 50-50 split. And then, when you're just a year or two away from needing that cash, the fund's main job changes. It's no longer about growth, it's all about protecting what you've built. So the portfolio becomes super conservative, with most of it in low-risk debt, to make sure your nest egg is safe from any last-minute market drama.
Now, to get this automatic balancing act right, these funds can invest in a whole range of different things. Of course, you've got your standard stocks and bonds, but they can also hold infrastructure investment trusts, or INVITs, and even get exposure to commodities like gold and silver through ETFs and specific derivatives.
All right, this all sounds pretty great, right? But to make sure these funds are truly safe and transparent, SEBI has put some very clear rules of the road in place. Think of them as built-in guardrails to protect investors. First off, these funds are built for the long haul. So to encourage people to stick with their goals, there are what we call tiered exit loads. If you try to pull your money out in the first year, you'll face a 3% penalty. That fee goes down over the next 2 years. The message is clear. These funds are for staying the course.
Second, and this one is so simple but so important, no more confusing names. The fund's name must include the target year, so it'll be something like XYZ Life Cycle Fund 2055. Right away, you know exactly what that fund is for. No more guessing games.
And third, there are really strict quality controls. When the fund invests in debt, those instruments have to be high quality, with a credit rating of AA or higher. And if it dabbles in commodity derivatives, it's strictly limited to gold and silver. This just ensures that the safe part of your portfolio is actually, safe.
Now let's zoom out a bit. The introduction of these life cycle funds is actually part of a much bigger mission from SEBI. The goal is to make sure all mutual funds are true to their label. It's a simple idea. A fund should do exactly what its name says it does.
A great way to understand this is to compare the dynamic approach of a life cycle fund with other types of funds.
For categories like value funds, contra funds, or even tax-saving ELSS funds, SEBI has actually increased their required minimum holding in equities to 80%. This ensures that if you buy an equity fund, it's always heavily invested in equities, unlike the lifecycle fund, which adjusts over time.
Another big cleanup is happening with thematic funds. You used to have situations where one fund house would have, say, an infrastructure fund and a PSU fund, but they both owned a lot of the same stocks. That's not real diversification. So now, there's a strict rule, no more than a 50% overlap. Fund houses have 3 years to fix this or merge their funds.
And this push for clarity goes even further. Credit risk funds? Well, now they actually have to take on credit risk, investing at least 65% in bonds rated 2A and below. There's a whole new category of sectoral debt funds for specific areas like finance and infrastructure. And fund houses can now offer both a value and a contra fund, but only if they have genuinely different strategies, again enforced by that 50% overlap rule.
So what's the big takeaway from all of this? The core idea behind all these changes is to simplify investing, boost transparency, and make every fund true to its label. It's all about creating a more investor-friendly world where making the right choice is just easier. And for anyone just starting their journey, the new Lifecycle Fund is a real game changer. If you liked the video, please do like, share, subscribe to Murthy Finance Academy.